Hello. On behalf of the American Association for Employment and Education, I'd like to welcome you to the AAEE-sponsored webinar, Student Loan Solutions, Helping You Recruit and Retain Employees. My name is Tim Newbert, and I have the privilege of serving as the new Executive Director of AAEE following the end-of-year retirement of Deb Snyder. Before we begin with our webinar, I'd like to thank some of my colleagues. AAEE Board Member Daphne Donaldson from East Baton Rouge Parish Schools, who directs our professional development program, and Sarah Russell, our Strategic Marketing Manager, for her leadership role in preparing and hosting today's webinar. Those attending live, please note that if you have any difficulties, you may send a message to any meeting by clicking the button in the upper right-hand corner. Also, during the webinar, all attendees will be muted. However, at any point, you may submit questions via the chat feature. Jim and John will allow time for questions toward the end of their presentation, so throughout the webinar, please submit your questions and comments via the chat box, and they'll try their best to respond to all questions during the event. If you are not currently a member of AAEE, you can find more information on our website at AAEE.org. We are an association that brings together the college and university professionals who prepare future teachers with the employers who hire them. Related to that mission, we offer publications and events such as the Job Search Handbook for Educators, an annual Teacher Supply and Demand Report, a calendar of education-specific job fairs held around the country, an annual conference and career fair, which was held in Pittsburgh, Pennsylvania last fall and will be held in St. Louis, Missouri in November, and of course, our webinars. Today, we're pleased to have our friends Jim Yale and John Bernardy from Horace Mann. Jim serves as Vice President for Association Relations, leading the company's efforts to assist employers with worksite programs designed to improve employee financial wellness, while John serves as Director of Student Loan Solutions, focusing on the company's efforts to help educational employees manage student loan debt. Today, Jim and John will share new ideas on how school systems can educate employees about managing their student loan debt, as well as understand how educating employees on available federal programming and strategies can differentiate the district when recruiting employees, thus improving employee retention. Thank you for your insights and information with us, sharing your insights and information with us today, Jim and John. I'll now turn it over to you.
Great. Thank you very much. Let me go ahead and we'll move to the presentation this afternoon. This is Jim Yale, and along with John Bernardy, we'll be walking through some information relative to kind of the current environment, as well as solutions that can be employed to help with a really important issue for many educators, but especially new educators. So my portion of the presentation is going to be a brief introduction to the company so that you know a bit about Horace Mann and the services that we can provide, and then set the stage with kind of the current environment. So I kind of have the gloom and doom, if you would, and then John has the good news with regard to the solutions that are available and how they can work in your district. So without further ado, a little bit about the Horace Mann companies. We're located in Springfield, Illinois. I do have to mention that as we go through the webinar, if a train goes by, you may hear a train in the background because we are in downtown Springfield, Illinois, next to the Abraham Lincoln Presidential Library and Museum. We were founded here by two educators back in 1945 who decided that teachers should qualify for a better rate on auto insurance. And so the company started back then as a part of their credit union, and now we are a national company, publicly traded on the New York Exchange, and we now offer a full range of insurance and financial services programs, as well as you'll find educational programs to help educational employees with financial wellness, protecting for their needs today, and then saving for their future and saving for retirement. Our commitment is to provide educators with affordable insurance and retirement solutions. And what I think we feel is very unique about our company is our educational approach to working with teachers and other educational employees. We specialize in helping employees understand their retirement system benefits, and we provide workshops on a range of topics, including the topic that we will cover today. We are a partner, in addition to being a sponsor of the AAEE annual conference and serving as a member of this organization. We're a strategic partner with the School Superintendents Association, AASA, ASBO International, which is the School Business Officials, and we're also a national sponsor of DonorsChoose.org. And our whole mission in our national partnerships is to work on ways to help educators with financial literacy and financial wellness topics, but also give back by providing support to help teachers with needs that the school district cannot cover through their normal budget. And we do educate on the use of DonorsChoose.org as a best practice for crowdsourcing for classroom needs. So that's a little bit about the Horace Mann companies. Let's turn our attention to the topic of student loan debt. And so the next slide provides some statistics with regard to student loan debt. The average teacher salary, according to the National Education Association, is just north of $36,000. However, the average college graduate loan debt, and John will reference this later on in the presentation, averages about $37,000. So the picture here is that starting teachers coming into the workforce have more student loan debt than they're able to make in a year with the average salary. And 13% of their monthly take-home pay, on average, is devoted to paying down that student loan debt. So it's a significant portion of their take-home pay, and it does provide some financial pressure for new educators when they come into the workforce. The two boxes that are here on the slide are actually from surveys that we do with teachers and other school employees as part of our Educator Advisory Panel, which is a virtual panel that we periodically will survey and work with on issues related to them. And a couple of points that they make are, we make less, so you just have to budget what you can afford. And the pressure is, in this educator's instance, is that I have very little extra money for savings. And the other quote, as you can see here, is that early in their career, teachers are paid significantly less, and it makes a struggle to pay off student debt. So that's the student loan crisis really kind of hits home, we believe, much harder on new educators because of those statistics, and I'm going to come back to how that compares with other occupations. But one of the other financial pressures on educators, and I'm sure you folks probably know better than we do, is that 85%, and we actually think this is a higher percentage, but our surveys show that 85% of teachers spend their own money on classroom supplies. 92% of those teachers actually buy instructional materials for their students. And on average, each teacher tells us that they spend about $500 a year for classroom needs. So, in addition to that, so we have the burden of student loan debt, plus whatever financial challenges that they have with regard to loans and credit cards and other expenses. But when you take a look at some information from the Economic Policy Institute, teachers, on average, are paid 12% less for the work that they do compared to other occupations that require similar educational requirements. And unfortunately, there's also evidence to suggest that this gap widens over time. So in terms of, another quote from our educator advisory panel members, this educator told us, one of my biggest worries is retirement because my salary is less to begin with, my retirement pay will be significantly lower, and as you look at what is occurring around the country with state teachers' retirement systems and public employee retirement systems, there is a continuing shift away from the defined benefit retirement plans and a shift toward defined contribution retirement plans, which is the reason why there is evidence that this gap is going to continue to widen over time. So as AAEE members, we're sure that you're fully aware of the teacher shortage. And moving to the next slide, and this actually includes additional information from the Learning Policy Institute. We've got an increased demand for teachers as schools continue to reinstate classes and programs that were terminated in the Great Recession, during 2008, 2009. There's a decreased supply of teachers, and teacher attrition remains high and is really the single biggest contributor to the shortage. Now, a couple of statistics as I continue to share, the gloom and doom portion of our presentation. What we're seeing is a decline in teacher prep programs. On our Thursday webinar, I'm sure that audience is definitely living through that. But this next stat is one that is really telling. So given all of the pressures, in addition to the non-economic pressures that teachers and other educational employees face, what we find, and it factors into their financial planning, 2/3 of educators leave the profession before full retirement age because they're dissatisfied for whatever reason. So all of these things are contributing to the environment now, and I saw a recent article that indicated, and I think actually it may have been from AAEE, that in every state in the country there is some sort of teacher shortage, especially in those subject matter areas that are tough to recruit educators anyway. And Lee Suture, as a part of the Learning Policy Institute workup, we felt made a really important point. And the point was that in times of shortage like this, policymakers often will focus attention on how to get more teachers into the profession. I think we do see that with incentive programs, with alternative certification programs, and the like. But the point that the Learning Policy Institute makes is that it's equally important to focus on how to keep teachers that we do have in the profession. And the interesting point here is that reducing attrition in half, in other words, if attrition could be reduced from the 8% per year that is normally seen to 4%, that it would virtually eliminate overall shortages in educators. So that brings us to the point of how in your districts pursuing a work effort to educate, focusing on dealing with student loan debt, that type of program could serve to, number one, differentiate your district when recruiting educators, as well as differentiate your district and potentially improve results from the attrition standpoint if you can get those folks who you recruit stay in the profession longer, reducing your attrition. So I'm going to move forward and kind of turn things over to John here. The next slide that we have here basically provides an overview of why it's important to solve for these financial issues. As I mentioned, educators tell us that they struggle with saving enough or not at all. They are uncertain about their state pension as well as Social Security. They aren't making enough to pay off student loan debt, or they believe that they don't make enough to pay off that student loan debt, and they find themselves, working in the classroom, spending their own money in order to really, do what they love, which is teach students. And so the effect on school districts is that all of these things strain the ability to attract and retain talent. It hurts morale. It causes lower productivity if folks are concerned with those issues that they're dealing with outside of the classroom. And the converse is that, you could have people leaving the profession, but the converse is that employees could work later in life and work because they have to, and that can contribute to higher benefits costs if you are in a district that is seeing an increase in the average age of your employees. So we believe that building programs to help employees focus on their financial success can help you improve your retention of educators. So I'm going to turn things over to John. The gloom and doom portion of this is almost over, and John's going to talk with you with regard to some solutions to help address the issues that I've just reviewed.
Yeah, thanks, Jim. Yeah, like he said, this is the final continuation of Jim's doom and gloom. Looking at this slide, the reason we've included this, we want to drill down into some of those issues, and for the rest of the purpose of this call, that issue is going to be student loan debt. And I wanted to we wanted to paint the picture of how bad it really is. If you look at this number, $1.4 trillion in student loan debt. It's 1.499 for you mathematicians out there, soon to be 1.5 next month. That number is so large that we wanted to kind of add some perspective for it. So if you think about credit card debt, and student loan debt is more than that. Think about auto debt, student loan debt is more than that. If you were to travel back in time 1 trillion seconds, you would not be in the year 1950, you would not be in the year 1700, you'd actually be in the year 33,000 BC. So 1 trillion is a lot. That's a huge number, and that's a big problem for us as a society. And it's actually a larger problem proportionally for educators and those in the education industry. Jim talked about $37,000 as the average undergraduate debt, and that's true. That average undergraduate debt includes all professions, and the numbers that we've seen internally from teachers, that number is a lot more like 50,000, 48,000, 60,000. It's very, very common for us to see young educators coming out. We saw one this morning with $73,000 in debt as a first-year teacher. We get this all of the time, and that really leads us to kind of the purpose of this call, and why Horace Mann and AAEE have a real strong reason to operate together. We see way too many teachers leaving the industry simply to find a career path that pays better. And that 71% number comes from our educator advisory panel that Jim referenced. So really, that's the doom and gloom. And for the rest of this show, we've got some good news for you. We wanted to talk about the solution that we've developed for the student loan problem. And it's something that really translates to the entire industry. So under Jim's direction, I've actually got the privilege to lead a student loan solutions team of experts here in Springfield. And our three goals are this: how can we work with teachers to help them remove their debt and just have it forgiven through various federal programs? The next thing we look at is how can we help them reduce or control those monthly payments to bring them to a more manageable level, something that they can afford to still live while making those payments responsibly. And then finally, the third task is how can we help them redirect those savings? As Jim kind of talked about, redirecting is so important because starting earlier, is much better than starting later on, and we're going to talk about that a little bit later in the presentation. But like I said, we've got a team dedicated simply to helping educators navigate these three things across the country, and we're seeing a lot of positive improvement from the schools and the districts we've worked with. So,
and John,
yeah.
quick question. There are businesses that actually charge folks to receive counseling and that on this subject, correct?
That is absolutely correct. Yes. So what Jim said, if you're on Facebook or if you drive a car and you've got satellite radio, if you're watching any sort of sports ad, there are companies out there selling student loan advice and guidance and help us. And a lot of them say that they're free until you have to pay for them. We see a lot of teachers that have worked with these companies, and they are very, very expensive. A lot of them will charge $1,000 up front with significant monthly fees, hundreds of dollars oftentimes. And we've seen educators be mistreated by these companies and sign away limited powers of attorney, all sorts of things like that. And one of the things that we help do here at Horace Mann in our Student Loan Solutions Department is to kind of make sure educators aren't paying for that help because these are usually free federal programs that they're navigating, and we want to make sure that they're educated, that they're eligible for these programs. Now, looking at the three overview programs we're talking about today, we want to make sure that that you're aware of these things that are available. So first, there's a Title I program, Teacher Loan Forgiveness, that's been around for some time. You're probably familiar with that. The second is Public Service Loan Forgiveness, and we'll delve into that. It's the second bullet point. And the third is particularly interesting if you are a parent and you've got a child in school. Now, this first topic is Teacher Loan Forgiveness, and this applies only to classroom teachers. The next topic is actually something that some of you on the phone might really benefit from. But back to Teacher Loan Forgiveness. This program has been around, and it is a program designed to help educators who teach in a low-income or school district that qualifies for Title I funding. Now, about 40% of America's schools do qualify for Title I funds, so this is a rather large percentage, and a lot of your graduates or a lot of your incoming employees will likely be going to school districts where this is available. The unfortunate thing is not a lot of districts know about this or advertise this at, say, a new teacher orientation or when a teacher comes on, here's your new teacher kit. They don't often include that you've been qualifying yourself for this program. Conversely, the colleges, more often than not, they have no regular ability to communicate that. They don't often teach that. There's a big gap there, and that's what we're seeing, and that's really why these companies that Jim referenced are spawning. They're taking advantage of these teachers. What we want to do is make sure that all teachers in these qualifying schools, these Title I or low-income schools, know that if they teach for 5 years, they're going to get $5,000 in loan forgiveness on their federal loans. And for those the harder to recruit positions, say special ed, and for the higher qualified secondary math and science teachers, that number jumps up to $17,500. One of the things that our agents, we've got, Jim mentioned 750 individual business agent owners across the country. They've been contacting school districts and schools that are Title I just to say, hey, anybody that's taught here for 5 years or more qualifies for this loan forgiveness. And if they'd like information on that, we're happy to talk with them at no cost about how they can get that. And that's a really simple thing. $5,000 for some people, that's a really good day. For some people, that's life-changing. But I wanted to really dovetail into public service loan forgiveness. Like I said, the previous program was for teachers only, classroom teachers, but public service loan forgiveness, in addition to being available to teachers, who often benefit from it, is available to anybody in a public service role or works in a non-for-profit 501c3 organization. I would wager that a lot of the folks listening in on this call qualify for public service loan forgiveness. There are 33 million Americans that do, and as of today, only 600,000 have applied. Now, the key to this program, and it's not exactly crystal clear here, but it's about as clear as we can make it, is simply this. You need to make, in order to have public service loan forgiveness, you need to make 120 qualifying monthly payments on the right type of loan while working for the right employer, which in this case would be that school district or that 501c3 nonprofit organization. And after that 10 years of payments, everything else that you owe is wiped out, completely eliminated, forgiven, tax-free. So what we at Horace Mann try to do is we know that school teachers and those working for the school systems already work for that qualifying employer. And what this program does is virtually guarantee that they're going to remain working for that employer for a 10-year period. And that's really where that retention impact can come in. So if you've got a brand new teacher coming in, working towards this forgiveness, you know that they're going to be there for 10 years. We help them make sure that they're on the right type of loan, which often they are, the federal direct loans, and then we help them make that qualifying payment. Now, a lot of teachers, the first thing they ask is, what's a qualifying payment? Is that $1,000 a month? Is that super expensive? It is. Well, there are two different types of qualifying payments, and I feel like we should go into what those look like. As far as the standard 10-year plan on this slide is the payment that you're first going to get right out of college. You're going to get a bill in the mail that says your first bill, in this case, this teacher has a $36,000 annual income and a $60,000 student loan debt, which, like we talked about, is not at all uncommon. So this teacher comes in and she gets her first bill in the mail, and it's for $755 a month. And that is going to eat up a large portion of her paycheck. She's probably not going to be able to move out of her parents' basement at this point, definitely not buying that new car, and surely not going on some sort of trip to celebrate her graduation. She's going to pay back over a 10-year period $90,500 for this loan. Now, oftentimes, this case, they'll call their loan servicer or call one of those companies, and their loan servicer, the person that holds their loan, say Navient, Nelnet, whomever, will often put them on a plan that does not even qualify for loan forgiveness. That standard payment qualifies. They'll put them on a 30-year version of this plan that does not qualify, that a lot of you have probably had 25 or 30-year loans, or maybe your children have loans that are 25 or 30 years. Those payments on those types of durations do not qualify for public service loan forgiveness. So in this case, this teacher decides to go to an income-driven repayment plan. This is something where teachers often aren't overpaid, and for this instance, that's a good thing. This person's individual income-driven payment plan is set to $149 a month. So by making one quick switch on studentloans.gov, she can immediately go from $755 a month to $149 a month. And this will put her on a path of that public service loan forgiveness, where if you look across, instead of paying $90,000, she's going to pay $25,000 and receive about $75,000 in public service loan forgiveness. That's a life-changing situation, that $75,000 in loan forgiveness. You can see why this would be a great incentive towards remaining in the profession, while at the same time starting early. One of the reasons we encourage teachers to start early is because, like we said, the power to redirect those funds for retirement is huge, but at the same time, your income is probably not going to be lower than it is when you first graduate school. So we like to help them start right away to get those qualifying 120 payments made so that they can have their debt forgiven as much as possible. And like we said, redirecting that money, that is very, very important. We encourage people to start early, even if it's just a lower amount. And I've got an example here to really draw all of this together. So this slide, if we had to pick one slide, I think Jim would agree, that summarizes our student loan presentation and why it's important to start early. This is the slide that does it. This slide could be all of your new and incoming teacher employees. We would encourage them to do this, and whether it's with us or with someone else, but let's meet Kate. So Kate is 24 years old. Her adjusted gross income, so after deductions, her income is $30,000. She's got $50,000 in student loan debt. She's looking at paying back $350 over the next 300 months, which I think translates in about 50 years, or 25 years, a long time. And then retirement savings, she's not saving anything. Now, simply by moving Kate to an income-driven payment, by working on studentloans.gov with somebody that knows how to help educators with their loans, her payment goes from $347 a month to $99 a month, saving her a whole bunch of money. And at this point, she's probably in tears. Now, we would suggest at this point, since she's not saving any retirement money, if she were to put a little bit of that savings into her retirement account, I want to show you guys the impact that can have. So in the third bucket, she puts $100 a month into her savings account, into her 403B in this case. And what that does is it lowers her adjusted gross income even more. So we go back and we recalculate that income-driven payment, and it's now adjusted from $99 a month to $89 a month. So in this quick step, she's going from paying $347 a month to now paying $89, and she's saving $100 bucks. So that's a great situation for this 24-year-old. Now, the fourth circle, the retention and confidence, that's her teaching for the next 10 years. She's going to keep making her payments. As her income increases, she can maintain that level $89 payment plan by increasing her 403B contributions. And so and that's exactly when she'll submit her public service loan forgiveness form. At that point, after that 10-year period, she'll be 34 years old. She's going to have $88,000 in debt forgiven tax-free, and she'll have about $20,300 in her 403B account, again at the age of 34 years old. That's a rather gigantic seismic pendulum shift here for Kate from being heavily in debt, not saving, not seeing the light at the end of the tunnel, 300 months, to having all of her debt paid off in 10 years, having substantial retirement savings already started with the time value of money on her side, and now the ability to spend that money elsewhere. This is something we like to see for a lot of young educators. We get this. Jim, our team receives about 225, 250 fact finders of teachers across the country a month, and we see this very, very commonly. These kinds of situations where this is an achievable goal to go from this mired in debt to having a lot of light at the end of the tunnel. Now, those on the phone, and I mentioned a little bit earlier, if you've got a loan for your child, you're probably familiar with the term Parent Plus loan. This is great because this is a great benefit for teachers as well as you on the phone. Those loans can also qualify for public service loan forgiveness. So if you've taken out a loan for your child to go to school, no matter what they're going to school for, you can have that loan forgiven by the same principle that we just looked at for Kate, by your service as a public servant. So if I'm a teacher and I want my child to be a lawyer or a doctor, and I take out a ridiculous amount of student loan debt, and I continue to teach after I've taken out that loan for 10 years, that loan can be based on an income-driven payment plan and forgiven just like any other loan for my child's education. So this is another one of those benefits where we feel like there's a huge, huge advantage to being an educator that's simply just not shared and unknown, because that's very, very powerful. And that's another reason to segue into the retention aspect. Finally, like Jim had mentioned earlier, we do not recommend paying for this. The Department of Education's website references multiple times, do not pay for student loan help. This is just not something that charges. And now you're asking, how do you, John, have a team that does this full time? My response to that would be that you will not see Horace Mann on a Super Bowl ad in the next coming weeks. You will not see us on Facebook sponsoring anything, but rather you will see us working in schools and colleges and school districts to help educators save money and find them dollars so that they can achieve these life goals and invest in their retirement. So that's what my team does. We actually work on finding educators money, and we do this for free. And hopefully, they'll spend that money wisely on important things such as retirement or paying down their debt. That's really our goal and what we get out of it. Finally, for those who have private loan debt, say 3 out of 10 borrowers, or let's say you borrowed the maximum amount of federal debt, but that didn't quite cover the cost of your expensive school, so you took out a private loan. We have a partnership with a bank, in this case Citizens, where we can help you refinance that debt for free at no cost to you, and hopefully get a lower interest rate for you. Our average educator that goes through this process, they've already been vetted. The forgiveness does not apply. This is only when the forgiveness options might not be in their best interest. We'll look at refinancing that debt, and the average savings is about $130 a month for our clients. So we're pretty proud of that partnership as well. Again, they've done a great job not omitting anybody's forgiveness. We're very, very careful with that. We want to make sure that everybody's making the right decision with regards to their loan benefits. And I think I'm going to flip it back to Jim. I think that wraps up our portion of the presentation today, but I believe we're going to take questions.
Yep. Thanks, John.
Yep.
Yep, that does conclude the presentation for today. We would like to go ahead and open the floor for any questions that you have.
Maybe that's a Sarah unmuting thing.
I saw the pop-up from Sarah with regard to questions. If you do have any, please share them at this time. If you do not have any questions at this time, or you don't feel comfortable sharing with the entire group, my contact information is on the slide in front of you. We'll also be working with AAEE to provide some information to be posted on the site, and then we will also be at the annual conference coming up in St. Louis. Until that time, though, we'd be happy to work with any of your districts. Just drop an email to myself, and it's jim.yale@horacemann.com. I'll get in touch with John, and we'll work with any of you who do inquire. Just so that you know, a couple of the services that we can provide. John gave an overview of how we assist employees. We'd be happy to share with you the way that we do that. There is a presentation that is similar to the one that you have just seen. However, it is designed for your employees. And in addition, we have a kit that is provided to each employee that includes an overview of the forgiveness programs, the strategy that John has just shared, and then we also include the paperwork so that they can complete either the teacher loan forgiveness or the public service loan forgiveness verification form. And in addition, just to wrap things up, as John indicated, we do have a team here at our corporate home office, as well as our field agency owners who are committed to helping educators and other teachers and other educational employees with this issue. And so to that end, we also have a brief fact finder that can be used with employees so that their information can be gathered. That can come into to John's team, and basically we can walk through and provide a recommended course of action that employee can pursue to reduce their monthly payments, eliminate student loan debt, and help them prepare for the future. So unless there are any other questions, we'll wait and see if there are, and then we'll conclude for the day. John?
I will add real quick that Horace Mann, our Student Loan Solutions team, we're proud to share, and it's been so recent that we actually don't have any materials for this yet, but over the last almost 3 years, we've helped educators like Kate achieve a projected $100 million+ in loan forgiveness nationwide. So this is something we're all in on. We are putting a lot of our time and our efforts into helping educators with this. Thousands of teachers last year took advantage of this service, and we encourage you and your districts and your new employees, as far as new employee orientations that you might have, to get in touch with us to get this started. One final little benefit I'd like to add for the group is that those income-based payments that qualify, those are based on your previous year's income, your previous year's tax return. So if I'm a new teacher and I just graduated college, chances are my previous year's income was not as high as it's going to be when I'm a first-year teacher. And for that, basing the income-based payments off of that senior and college income, they're often $0 a month. So we can see the first year of student loan payments being virtually free. Will they be $0 a month? And those $0 a month payments count towards the public service loan forgiveness. So we really like to see the young educators get started on the right foot with that. And if there's any option that we've got to connect with your new teacher orientations or new hire programs, we'd like to do that.
Thanks, John.
Yeah, this is Tim Newbert, AAEE Executive Director. I just want to thank Jim and John again for their time and the tremendous information included here. Again, for those of you who are listening to this presentation and not current AAEE members, please feel free to encourage you to explore our website at AAEE or AAEE.org. Thank you so much, everybody. Thanks, Jim and John.
Thank you.
You're welcome. Thank you.